What if I told you that paying cash for your next car in full, upfront, is actually one of the worst financial decisions you can make in America today? I know. You've heard it your whole life. Never go into debt. Save up. Pay cash. Own it outright? Your parents said it? Dave Ramsey says it. Your uncle, who thinks he's a financial genius, says it at every Thanksgiving dinner. But here's the thing. That advice was built for a different era. And if you're blindly following it in today's financial landscape, you could be leaving thousands of dollars on the table, money that could be working for you instead of sitting in a dealership's bank account. By the end of this video, I'm going to show you exactly why financing your car done the right way is often the smarter, wealthier move. We're talking real numbers, real strategies, and real opportunities that most Americans don't even know exist. So buckle up. Class is in session. Segment 1, the pay cash MYTH, where it comes from. Let's start with some context, because this isn't about being reckless. The advice to pay cash for everything came from a good place. Decades ago, consumer debt was genuinely dangerous. Credit card rates were sky high. Predatory lenders were everywhere. And most people didn't have access to low-interest financing. Paying cash was the smart move, because the alternative was getting crushed by interest payments. But here's what changed. Number 1, interest rates on auto loans can be extremely low. For buyers with good credit in America, it's still very possible to find rates between 3% and 6% on a new vehicle. Some manufacturer deals even offer 0% financing on select models. 0%. That means you're borrowing money for free. Number 2, inflation. Right now, $1 today is worth more than $1 tomorrow. When you borrow money at a low rate and inflation is running at 3 or 4%, you're essentially paying back the loan with cheaper money. The math works in your favor. Number 3, investment returns. The S&P 500 has historically returned an average of about 10% per year over the long run. If you have $40,000 in cash and you spend it all on a car, that money's gone. But if you finance the car at 5% and invest that $40,000 instead, you're making more than you're paying in interest. That's called arbitrage, and wealthy people do it all the time. So the question isn't, should I go into debt? The question is this debt working for me or against me? Low interest car financing. In most cases, it's working for you. Segment to the real cost of paying cash. Let's get into some real numbers, because I want this to really click. Imagine you've saved up $40,000 and you're ready to buy a car. Option A, pay cash. You walk into the dealership, slap $40,000 on the table, drive away free and clear. No monthly payment, no interest. Done sounds great, right? But let's look at what you gave up. That $40,000 invested in a broad index fund averaging 9% annual returns over 5 years would grow to approximately $61,500. That's $21,500 in gains, money you never made because you spent it all on a depreciating vehicle. Option B, finance the car. You'll put $5,000 down, finance $35,000 at 5.9% over 60 months. Your monthly payment is about $674. You invest the remaining $35,000 over 5 years at 9%. That grows to roughly $53,800. You gained about $18,800 in investment growth. Meanwhile, your total interest paid on the loan over 5 years is approximately $5,400. So, $18,800. In investment gains minus $5,400 in interest equals $13,400 net benefit from financing. You literally made $13,400 more by not paying cash. That's a vacation. That's an emergency fund. That's a down payment on a rental property. Now, this only works if, and this is critical, you actually invest the difference. This isn't an excuse to blow the money. The discipline is a strategy. But if you have the financial maturity to actually do it, financing beats cash almost every time when rates are reasonable. Segment 3, the credit score angle. Here's another reason paying cash can quietly hurt your credit score. In America, your credit score is your financial fingerprint. It affects your mortgage rate, your insurance premiums, your ability to rent an apartment, sometimes even your job prospects. And one of the biggest factors in your credit score is your credit mix, meaning lenders want to see that you can responsibly manage different types of debt. An auto loan is one of the best tools for building and maintaining strong credit. It's an installment loan, fixed payments, fixed timeline, and when you pay it on time every month, it sends a powerful signal to the credit bureaus that you are a reliable If you pay cash, you get zero credit benefit. The transaction doesn't even show up on your credit report. It's as if it never happened from a credit building perspective. And here's where it compounds. If your credit score is higher because you've been responsibly managing an auto loan, you'll qualify for better rates on future loans, like your mortgage. Even a 0.5% difference in mortgage rate on a $300,000 home can save you over $30,000 over 30 years. Paying cash for your car can literally cost you $30,000 on your next home purchase. Think about that. Segment 4. Liquidity, the silent wealth protector. Let's talk about something most people overlook entirely. Liquidity. Liquidity means having access to cash when you need it. And in personal finance, liquidity is a superpower. When you dump $40,000 into a car, that money is locked up. Cars depreciate fast. The moment you drive off the lot, a new car loses somewhere between 9% and 11% of its value. Within the first year, you might lose 15 to 20%. By year 5, it could be worth half of what you paid. So your $40,000 might now be a $22,000 asset. And if an emergency hits, job loss, medical bills, a business opportunity, you can't access that money without selling the car. You can't cut it in half and sell a door. It's illiquid. But if you financed the car and kept your $35,000 in savings or investments, you have options. You can weather emergencies. You can seize opportunities. You can sleep at night. Financial advisors call this your opportunity cost. The cost of what you give up when you make a choice. Every dollar you lock into a depreciating asset is a dollar that can't grow, can't protect you, and can't make you wealthier. Keeping your cash liquid is one of the most important principles of building lasting wealth. Car financing helps you do exactly that. Segment 5. How to finance a car the smart way, okay? So now you're thinking about financing, but I want to be very clear. There's a right way and a wrong way to do this. The wrong way is walking into a dealership with no preparation, accepting whatever rate the finance manager offers, extending a loan to 84 months to lower the payment, and ignoring the total cost of the loan. That's how people get trapped. Here's the right way. Step 1. Know your credit score before you walk in. Pull your free credit report at annualcreditreport.com. Know your score. Lenders offer very different rates to people with 720 scores versus 650 scores. If your score needs work, spend a few months improving it before you shop. Step 2. Get pre-approved before you visit the dealership. Go to your bank, your credit union, or an online lender like Lightstream PenFed or Capital One Auto Finance before you set foot in a dealership. Get a pre-approval letter with a real rate. This does two things. It tells you what you actually qualify for, and it gives you negotiating leverage at the dealer. Dealers make money on financing. They mark up the interest rate they get from lenders and pocket the difference. When you come in pre-approved, they know they can't play that game. Step 3. Negotiate the car price separately from financing. This is huge. Dealers love to talk in monthly payments because it obscures the total cost. Don't fall for it. Negotiate the purchase price of the car first, then talk about financing. Keep them completely separate in the conversation. Step 4. Choose the right loan term. Shorter terms mean higher monthly payments, but less interest paid overall. Longer terms mean lower payments, but you'll pay significantly more over time, and you risk being underwater, owing more than the car is worth if you need to sell early. As a general rule, 48 to 60 months is the sweet spot for most buyers. Avoid 72 or 84-month loans unless you have a very specific, disciplined reason. Step 5. Consider a modest down payment. You don't need to put zero down. That can put you underwater quickly. Aim for 10 to 20% down to reduce your loan balance, lower your monthly payment, and protect yourself from depreciation. Step 6. Actually invest the difference. This is non-negotiable. If your plan is to finance the car and invest the cash you kept, do it. Set up an automatic transfer to your brokerage account the same day your car payment is set up. Don't let the money sit in checking where it'll get spent. Segment 6. What about 0% financing deals? Let's talk about the holy grail of car financing to 0% APR deals. These promotions, often run by manufacturers like Ford, Toyota, GM, and Hyundai, allow qualified buyers to finance a vehicle with literally zero interest. You borrow $35,000, you pay back $35,000. No more. If you pay cash in this situation, you are genuinely giving away free money. Think about it. You take that $35,000, put it in a high-yield savings account earning 4 to 5% interest, and let it sit there while you make monthly payments from the interest you're earning. You're essentially getting paid to drive a new car, or invested in the market and potentially earn 8 to 10% per year. You're making money on money that you technically spent on a car. Now, there are caveats. These 0% deals are typically only available to buyers with excellent credit, usually 720 plus, and they're often on specific vehicles or trim levels that the manufacturer wants to move. They may also not stack with other rebates. Sometimes the manufacturer gives you a choice between 0% financing or cash rebates. You'll need to do the math on which is better for your situation. But here's the bottom line. If you qualify for 0% financing, there is absolutely no financial argument for paying cash. None. You'd have to be leaving a guaranteed return on the table to do so. Segment 7. When paying cash might still make sense now. I want to be fair, because I'm not here to give you one-size-fits-all advice. There are specific situations where paying cash still makes sense. Situation 1. You're buying a used car privately. Private sellers usually want cash. They don't want to wait for financing approvals, and you can often negotiate a much lower price when you're a cash buyer. In this case, cash gives you negotiating power that might outweigh the investment arbitrage. Situation 2. You have bad credit and can only get a high-rate loan. If your credit is struggling and the best rate you can get is 15 to 18% APR, the math flips hard. At those rates, you're definitely paying more in interest than you'd likely earn in investments. In that case, save up, pay cash, and then use other credit products to rebuild your score. Situation 3. You're the type of person who won't invest the difference. Honesty check. If you know yourself well enough to say, I will not actually invest that $35,000, it'll get spent, then financing might not be right for you. The strategy only works if you follow through on the investment side. Self-awareness matters in personal finance. Situation 4. You have extreme debt aversion. Some people's mental health genuinely suffers when they carry debt. Even low-interest debt. Peace of mind has real value. If monthly car payments would cause you significant stress despite being financially optimal, that's a valid reason to consider cash. The wealthy mindset. Here's the thing that ties all of this together, and it's something I want you to really sit with. Wealthy people don't avoid debt. They use debt strategically. The wealthiest Americans carry mortgages on investment properties. They use business lines of credit. They finance purchases when the cost of borrowing is lower than the return on their capital. They are not afraid of debt. They are disciplined about it. The myth that all debt is bad keeps millions of middle-class Americans from building real wealth because they're so focused on being debt-free that they're also opportunity-free. Your car is a depreciating asset. It will lose value every single year, no matter what you do. The smart move is to minimize the cash you lock into it while keeping your capital working, growing, and compounding in your favor. Finance smart. Invest the difference. Build your credit. Protect your liquidity. That's not reckless. That's the wealthy way to buy a car. Alright, that's a wrap on today's video. If this changed the way you're thinking about your next car purchase, do me a favor, hit that like button. Drop a comment below telling me how you're planning to buy your next vehicle. And subscribe if you haven't already. And if you want to go even deeper on making your money work smarter, check out my video on insert related video. I'll link it right here. As always, don't just earn money. Make your money earn. I'll see you in the next one.